Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello, everybody, and welcome back to the 360 Money Matters podcast. I'm Billy, and I'm joined by
Andrew. Good to have you all back and listening to another episode.
Very exciting, Andrew. Today, we've got something special for our listeners. We're actually going to talk about a strategy that we've been discussing recently with a client of ours and thought that to be really valuable to our listeners to get an understanding of what this looks like. Andrew, you want to give us an intro as to what the strategy was?
Yeah, so today we're talking all about a debt recycling strategy is what it's called. It's a little bit more, so we're going a bit more technical today. It's a little bit more technical to what some of the other podcasts are, but I think that it's incredibly valuable strategy. It's a means to be able to pay down your non-deductible debt as quickly as possible. It also helps you build wealth in a tax-effective manner. So it's something that really hits all of the pain points when you're talking about a wealth creation strategy, Billy.
You're absolutely right. Ticks a lot of the boxes. And one of the things that you did touch on it, I'm just going to drill down a little bit further, but one of the things that we find, and I've definitely experienced myself as well too, on your wealth creation journey, on your investing journey, that your owner-occupied debt, so your mortgage, your non-deductible debt, I don't know about you, Andrew, but it always seems to be this thorn in my side. I look at it, it's a 30-year term, I'm making additional repayments, so I'm doing all of the right things, but it just doesn't seem to move the needle very, very far, and it still seems like this light at the end of the tunnel is so far away. So this strategy will hope to address some of that and how we can bring that forward. But that's one of the things that really resonates with me.
It's always a killer. I mean, when you consider that you're paying a mortgage for most people, or you're making repayments every single month on what's the average non-deductible debt across a home loan at the moment? I mean, you're probably talking somewhere in the range of $600,000-$700,000. And you're paying that off over 30 years, it's just so difficult to really do anything that's going to move the dial in terms of actually having a valuable impact in the short term. I mean, yes, of course, making additional repayments and doing it is obviously an effective strategy, but it just seems so far away that having a strategy and having something in place that can have a fairly immediate impact is massive.
No, absolutely. So this scenario that we had with the client, the debt recycling strategy, which we'll dig into now, was really the solution that we came up for with them. So we might actually start off and run some details around what a debt recycling strategy is, and we'll see if we can do this justice, Andrew, because every time we do talk to people about this, we've always got the benefit of having either a piece of paper or a whiteboard or something like that to be able to map it out and talk through it as we're going. So doing this just on a podcast with audio is going to be challenging, so it's definitely going to stretch us, but we'll try our best and see how we go.
Yeah, I'm a visual person, so it's definitely going to be a little bit challenging to describe, but I think we're up for the challenge, Billy. We're a few podcasts in where I'm not going to say veterans, but got a little bit more experience under our belt, and I think that we can do it justice.
We'll see how we go. And all right, here we go. So in essence, a debt recycling strategy, and Andrew, you can jump in when which of this and if there's any parts that I've missed, but essentially a debt recycling strategy in the simplest form or in the simplest terms is using a strategy between deductible and non-deductible debt and investment to try and essentially pay off your non-deductible debt faster. So I'll dig a little bit deeper into what that is. But essentially what you've got is with your home loan, so your owner-occupier, the place that you live in, the debt that you've got associated with that, you can't claim that as a tax deduction. There's no investment benefit from that perspective. It's purely, in the eyes of the tax department anyway, it's purely just to house you in terms of your accommodation. So there's no tax benefit like there is with investment debt, where you can claim the interest as a tax deduction.
Yeah, so your non-deductible debt is, if you put it in the column of good debt and bad debt, it's sitting further towards the column of bad debt because of the fact that it's not for an investment purpose and you can't claim a tax deduction on it.
Correct.
Which is why we'd want to obviously pay that off at a more rapid rate than you would your good debt or your investment debt that's tax deductible.
Absolutely spot on. So the key with the debt recycling strategy is using an investment, and we'll get into some details in a minute, but using an investment to accelerate your debt reduction payments on your non-deductible debt. So essentially trying to pay down your home loan, your owner-occupier non-deductible bad debt home loan down as fast as you can. That was a bit of a mouthful there. As fast as you possibly can. And at the same time, using the good debt, so the investment debt, that continues to grow over time because we want to claim a tax deduction on that. So there's a bit of a tax arbitrage opportunity that we're taking advantage of here. But essentially, that's the overarching strategy in terms of what we're trying to achieve.
Yeah. So the overarching strategy is you're converting your debt that's not deductible into deductible debt in a perfectly legal and tax effective manner. I guess a good sort of starting point before we start to run through the intricacies of the strategy is who can do this and who is this strategy appropriate for? It's not for everyone because of a few things, including risk tolerance, but also your circumstances. So tell us, Billy, what type of people is this sort of strategy generally best suited to?
I think the first thing that you need to be comfortable with is from a debt perspective, all you're doing is converting. So over time, all you're doing is converting your bad debt into good debt. So your debt position stays the same. So at its very core, when we're talking to clients and trying to identify whether or not this strategy will suit their circumstances, there has to be a tolerance to move through a period of time where you're actually not reducing any of your debt. All you're doing is moving it from the left column of non-deductible debt to the right column of deductible debt. And the quicker we can do that, the better off you are from a wealth creation and a tax perspective as well too. But that's probably the first thing that I'd look at in terms of, hey, do the clients that we're talking to have the appetite and do they feel comfortable enough with looking at their debt and seeing that it's actually not going down over time? That's probably the first thing. And if you can't get through that hurdle, basically that strategy is off the table. But that's definitely the first thing that I look at from that perspective. And then after that, probably the next thing, Andrew, would be...
Yeah, so the next thing is you obviously have to have some form of debt. So if you don't have an owner-occupied debt, if you don't currently own the property that you're living in, then you sort of fall over there and there is nothing to do with this strategy. I mean, obviously there's other things that you can do with increasing and growing your wealth. However, having an owner-occupied or a non-deductible debt is the first thing. And there also needs to be an element of equity in that property. So if you're already leveraged very highly, if you already have a property at 90% LVR, which means 90% of the value of the property is covered by a loan, then you don't have the ability to draw additional equity out. And so the strategy doesn't suit you. So making sure that there's equity that's available in your owner occupied property is the other thing that you need to make sure of. And the other thing is you have to have a tolerance to risk. So when you're embarking on this strategy, and it'll be apparent once we sort of run through the intricate details, but you're effectively drawing out equity on an owner occupied property. You're putting that towards an investment vehicle. And so you're taking on debt in order to invest for obviously a greater purpose, which has its own risks associated with it. And so making sure that you're not a very conservative investor is the other thing, because it is a riskier strategy than some of the other strategies that you can employ.
Mm-hmm. Yeah, and also having secure income as well. So I think that's probably quite crucial. If you are talking about this particular strategy, then you want to make sure that your income is secure, and not that there's no real risk, because there's always risk that people's income and stuff stops. But if you're in a position where your income is probably in an industry that's more secure than not, that's always a benefit as well too. As well as having good money management, cash reserves, emergency funds, and other bits and pieces also associated with this. When we are talking to clients about it, is the risk strategy as well too. So making sure you've got all of your insurances in place and all of your ducks lined up in order to do it.
Yeah. I mean, most of the time, I think almost every time that we've recommended a debt recycling strategy to a client, it's the second or third step along the road. So it's not the starting point. Most of the time you've already invested in a portfolio outside of just property previously. So usually most clients will have some experience in investing outside of only property. So you're sort of embarking on this strategy after you've gotten the comfort levels associated with investing in shares and managed funds and alternative assets outside of property.
Yep, well said, Andrew. I'm going to try and jump into some numbers as an illustrative example here. So we'll see how we go and hope that this comes across all right. Let's use a really simple example where a homeowner has equity available within their property and they borrow, we'll use $100,000 because it's a nice round number. They'll take that $100,000 out of their home as equity and they'll move that $100,000 into some form of investment that's providing a rate of return. And just for illustrative purposes, I'm going to say that we can borrow that $100,000 at a 3% interest rate. So from an annual cost perspective, to borrow the $100,000, it's going to cost us $3,000. Putting that $100,000 into an investment, if we can generate a rate of return of say 7%, the absolute return in year one is $7,000. If we deduct the cost of the interest from the return, so $7,000 less the $3,000 interest, it leaves us with a net gain of $4,000. That $4,000 is what we're using to make an accelerated debt repayment on the non-deductible owner-occupier debt.
And that's the key. You're paying the non-deductible debt. So you've taken an additional $100,000 loan against the property, but you're not utilizing it to pay down that loan. You're utilizing the net benefit that Billy's talking about to pay down the non-deductible debt, so the other bad debt that's associated with the property, and make accelerated and additional repayments towards that debt.
Yep. So we've got that first benefit from that perspective. The second benefit is that you've taken on some debt that is now tax deductible. So eventually when you do your tax return at the end of the financial year, some of that deductibility will come through in terms of giving you a benefit with your assessable income as well too. And obviously that'll change depending on how much debt you do have and how much interest that you are paying on the loan that you do have associated with that investment.
Yeah. So again, key highlights around what you're doing with the strategy: drawing equity out of an owner-occupied property, utilizing that equity to invest in a portfolio. Now, most of the time that's around shares, managed funds, those types of assets. The income that's derived from those assets, you're utilizing that to pay down your non-deductible debt and make additional and accelerated repayments towards that, whilst keeping your investment debt the same. So I think the other key thing within that is you want to make sure that those loans are structured correctly and that you've got the right structure around those loans, because you want your non-deductible debt to be paid down. However, your deductible debt, you want that to remain stagnant. So how do you do that, Billy?
So look, there's a couple of simple things. I mean, you need to make sure that your mortgage broker that you're dealing with has some experience in this particular area. But essentially what you're doing, and it's really critical to keep these separate, because from a record keeping perspective, so when you do your tax return, it's nice and easy for your accountant, but you need to have the two loans. They have to be split out. So you can easily identify which is your home loan, so the non-deductible debt that you've got on your owner-occupier, and the other loan needs to be split out as your investment debt. So it's really easy to be able to identify those and to be able to see not only what your liability is, but also how much interest that you've paid, because that's what's going to go on your tax return at the end of the financial year. So making sure that you've got clarity around the strategy, you're using a mortgage broker who has some experience in this particular area. And then from a loan structure perspective, it's making interest-only repayments on your investment debt, so your good debt, because you don't want to drive that debt down. It's actually the opposite. We're going to drive that up over time. And then on your owner-occupier bad non-deductible debt, you want to make not only the principal and interest repayments, but any cash flow benefit that you get from this strategy, you're making as an additional repayment onto your non-deductible bad debt on your owner-occupier to drive that down as fast as we possibly can.
Yeah, so making sure that non-deductible debt, a few things you want to be, obviously, you want to have the ability to make principal repayments on there. So I think one of the key things is if you've got a fixed interest rate, or in particular a loan that doesn't allow you to make additional repayments, then that's not suitable. So you want to make sure that you have the ability to make additional repayments, particularly around that split on the loan and across that debt that's associated with the strategy. I guess the other thing is making sure that you're receiving advice and investing in high quality assets that are going to deliver that rate of return and that income. And I think the key is, yes, you want some capital growth and you want in the investment that you're putting the funds use, or you're utilizing the funds for, you obviously want an element of capital growth. So you want that to go up in value, but you also want to make sure that you're structuring the investments that they're cash flow positive, that you're receiving. Yeah. Correct. Because
it's the income that we're using here in order to really drive this strategy, right? So we definitely need investments that are are producing a high yield or a high level of income coming out of it.
Yeah, correct. And that ultimately comes down to any investment strategy that you're doing or any sort of investment that you're doing. It's all around what are the goals and what are you trying to achieve, and purely looking at the net rate of return doesn't paint the overall picture, and making sure that you're structuring your investments to income producing assets is kind of imperative in this strategy.
Using that example that we were talking about before, where in the first year you've made an additional repayment of $4,000 on your home loan. What we would then do, and this is a fairly simplistic explanation, but what we would then do in year 2 is borrow against that position, so that extra $4,000. You'd take that out, and once again, you'd rinse and repeat, and you'd do the same thing. You take that $4,000 of equity or the additional repayment that you've made, and you'd shift that across into or you take that out from the investment loan. So your investment debt would go up by the amount that you've made as an extra repayment in the previous year.
Yeah. So
much easier with a whiteboard, I must say, Andrew, that's for sure.
Yeah. So what you do is, if you consider your debt position at the end of year 1, as Billy was saying, your debt position on your owner-occupied property would have gone down by $4,000. And so what you do is you draw that equity out, convert that to an investment debt. So your investment debt becomes $104,000. You use the $4,000 for investment purposes, and then the income that's produced from, hopefully that's gone up in value as well, but the income that's produced from those assets is used to, in the next year, pay down your non-deductible debt again. So effectively what you're doing is you're not embarking on this strategy just once, and you're not doing it just in year 1. You're doing this continually, so that over a period of time, you get to a position where you've got what was an owner-occupied debt that's completely expunged, and what you're left with is only an investment debt. And at the same time, not only are you getting a tax deduction on the investment debt, but you've also built a portfolio of assets outside of just that property. So you've effectively managed to, you sort of consider your starting position is you've got an owner-occupied property, you don't have any income that's deriving from it, and you're just making mortgage repayments from, I'm assuming, your income and your salary. At the end of this strategy, you've got an owner-occupied property still, you've got an investment debt that's associated with it that's now tax deductible. And in addition to that, you've also got a portfolio of assets outside of that property. So you've managed to convert one really simple asset to 3 different types of assets, or 3 different types of things that are all working towards your wealth creation. And if you consider this in the broader context of not only embarking on this strategy, but doing all of the other things that we've spoken about with investments at the same time, you're golden.
Yeah, and that's really the crux of the strategy from that perspective. It gives you the ability to really, like I was saying right at the start, get rid of the real pain point that a lot of our clients experience is the owner-occupier debt, because it takes such a long time and there is no tax advantage to it. When you've got debt, different story when you sell the property and it's capital gains tax-free and bits and pieces like that. But realistically, this is a strategy designed to be able to pay off your home loan faster while being able to build up other assets outside of that as well too. So you're kind of achieving multiple things all in one go. And ultimately, when we do get to the end of the day where you have expunged your owner-occupied debt, I mean, we're still going to have a debt associated with it, well, not with the house, but with the investment that you do have. But there's a couple of strategies that we've got from that perspective to discharge the debt or to manage the debt as well too. So usually there's a couple of things that we could do. We could either sell down the portion of the investment portfolio in order to discharge the debt in its entirety, or what we can do and what clients do tend to do because they don't want to necessarily sell down a large portion of their investment is that they use the income that comes off that investment and then just divert that income like we've been doing originally, rather than diverting it to the owner-occupier non-deductible bad debt. You just start diverting that towards principal reduction on the investment debt that you've got as well too. And obviously there's a bit of a bigger play that comes into account here and a bigger consideration in terms of your cash flow, your tax position and bits and pieces. So what's more favourable for your circumstances at that point in time. But ultimately it gives us flexibility at the end of the day, what we can do in order to manage the debt that we've still got left, even though it is no longer bad debt, it's all good debt. But once again, there's a strategy that sits behind that to be able to manage that as well too.
Yeah, exactly. So, I mean, not to downplay the fact that debt is still debt. And so ultimately, for most wealth creation or most retirement plans, you're usually aiming for a debt-free position at the end of it. And so all that we're doing here is not saying don't pay down your debt. It's pay down your owner-occupied debt, pay down your non-deductible debt. Once that's expunged, then you start to begin paying down your deductible debt. As Billy said, there's various strategies in order to do so. You can sell down the portfolio that you've built, and very likely there should be, especially if the assets have performed how you'd expect. Even if you pay down the portfolio in its entirety by embarking on this strategy, you should still have money left over in the portfolio if you do liquidate it to pay down the debt. Or alternatively, you utilize the income that's derived from that portfolio to pay down the debt over time. There's the ability to downsize on the property. There's a whole bunch of in-betweens that you can do in those sort of two black and white strategies. But ultimately, and that's sort of one of the other things that you need to have when you're embarking on a debt recycling strategy, is an exit plan. How do you exit this after you've completed the strategy, and what's the plan that's going to do it in the most tax effective and appropriate manner for your circumstances?
Yeah, no, you're absolutely right, Andrew. I mean, the risk associated with this can't be downplayed. It is a very aggressive strategy. It's quite technical as well too. If you are considering this particular type of strategy, you need to get advice on it, plain and simple.
And we sort of not downplay that, but we obviously provide our listeners with information, and it's all information and it's all generic and not tailored towards your circumstances. But I guess stressing that point in relation to a debt recycling strategy is kind of imperative, that if you are embarking on something like this, it's really important that you receive some good quality advice, because there is complexity with it. And with complexity, there's also the some risks associated with embarking on this type of strategy. So sorry to cut you off there, Bills.
Well said. Well said. You summarised what I was thinking anyway. But getting advice will also ensure that the risks associated with this type of strategy are being not only explained and addressed, but there's a comprehensive strategy that sits behind it to make sure that if things do start to go sideways, there are some contingencies in place to be able to cater for that as well too, because you can't just put one of these strategies in place and assume that the low interest rate environment that we're going to be in is going to stay here forever, or everybody's going to be in full employment, we're never going to have any issues. You've got to take all of those things into consideration when you are building this thing. And when we make these recommendations to clients, we're taking a broad range of factors into consideration to make sure that it is appropriate for our clients and their circumstances. Because when these strategies work, they're absolutely fantastic from a wealth creation perspective, and really driving down the owner-occupied debt and accelerating that. But once again, it's imperative that it's done correctly and it's done prudently, and there's a very, very sound risk mitigation strategy that sits over the top of this thing as well too.
Yeah, and making sure that just because it's appropriate and everything stacks up today, that's perfectly fine, as you said, and sort of touched on. Making sure that it works while interest rates are low is fairly easy. But what happens when interest rates rise, especially when you're embarking on something like this, most debt recycling strategies will last for sort of a minimum term of 7 to 10 years plus. So it's a long-term strategy. So making sure that just because it's appropriate today, that's fine. Making sure that it's appropriate in perpetuity is imperative.
And probably the last thing, Andrew, is just, and it's difficult to be able to try and illustrate this without either some modelling software that we use or a whiteboard and stuff. But the question that I often get asked by clients when we are discussing this is, why not just make accelerated mortgage repayments and just be done with it by paying extra off our mortgage? I mean, what's the difference? Why don't I just go down that path?
Yeah. And for some people, that's the right strategy. For some people, that's going to meet all your goals and objectives, and you can not need to embark on this level of complexity and risk really that's associated with it. By purely just making additional repayments towards your owner-occupied property, the thing that you're losing out on as opposed to embarking on a debt recycling strategy is the tax benefits associated with converting your debt from non-deductible to deductible, as well as at the same time building an asset that's outside of your family home. So building a portfolio of shares, managed funds, whatever that is, that's outside of your family home is the other additional benefit with embarking on this that you wouldn't get if you just made additional repayments towards your owner-occupied property.
Yeah, well said. I mean, when we sort of lay two strategies side by side, you've got a home loan that runs for 30 years. Maybe you make accelerated debt repayments and you pay it off rather than in 30 years, you do it in 20. So you've done a great job. You've gotten rid of it quicker. And then what you do from the 20-year mark forward, you start investing money to build up your asset base.
Hopefully you see an advisor and you do a combination at the same time. But yep, I get you.
Running them like that, that's a worthwhile strategy, and that can work for some people too. So essentially with the debt recycling strategy, what we're looking at is achieving both of those things at the same time, especially from the investment perspective, because you're starting early and you're giving it time to compound, which, as we know in previous episodes, one of the key fundamentals with investing is letting the compounding effect do its thing and have its positive effect on an investment. So making sure that we're getting into that investment as early as we can to allow that compounding to do its thing. And when we lay those two strategies side by side, very often we're much better off with the debt recycling strategy when we look at not only in terms of the numbers and how much interest that you're paying in bits and pieces, but also in how much time you're saving in terms of getting to your final goal and objective faster.
Yeah. And that's the key with it, is making sure that you've got that goal, you've got that objective, so that you know that this is the right strategy for you, rather than just, it becomes very easy to, especially in this technology and information age that we're living in at the moment, have so many different opportunities across growing your wealth, achieving all of the things that you want. And it can sometimes get overwhelming to continually be on that rat race of embarking on a whole heap of strategies, a whole heap of things in order to achieve your goals. But once you've got what that goal, what that objective is, and you sort of fit the pieces of the puzzle together as the strategy on how to get there, it's far more powerful and far more direct in your approach than just embarking on a whole bunch of strategies that just sound good on paper.
Well summarised, Andrew. I think we've done it justice.
I think we managed to sort of outlay a pretty comprehensive and a pretty technical driven episode into something that at least makes sense in my mind. So if it doesn't, reach out to us. Happy to discuss this in relation to your own personal circumstances and in a little bit more detail. But I think we did manage to do it pretty well justice, Billy.
That's it. And to our listeners, thank you once again for your time. We hope you got a lot of value out of this episode. Like Andrew said, if you require any further information or want to reach out, feel free to do so. We'd love to have a chat. And thank you once again for your time.
Appreciate your time, appreciate your attention, and looking forward to the next one.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.